Hello and welcome. Have you ever wondered how some families manage to protect and grow their wealth across generations? Well, a big part of the answer often involves a financial structure known as a trust. And in this explainer, we're going to pull back the curtain and show you exactly what they are and why they are so incredibly important. So today, we're going to deconstruct the idea of a trust, piece by piece. We'll start with the absolute basics, its structure. Then we'll dive into what is arguably its most powerful feature, a really unique tax advantage. And finally, we'll see how all of this gets applied in the real world. Here's our roadmap for today. We'll start with the fundamental question, what is a trust? Then we'll explore its tax advantage, explain the different types, cover some key tax rules you have to know, and wrap up with how trusts are used in practice. Let's jump in. Okay, first things first. What exactly is a trust? Before we get into all the complex stuff, you really have to understand that there are three essential roles, three key players involved in every single trust. You see, at its very core, a trust isn't a thing you can hold. It's a legal relationship. It's an arrangement where one person, who we call the settlor, gives property to someone else, the trustee. Now, that trustee has a legal duty, a fiduciary duty, to manage that property for the good of other people, and those are the beneficiaries. So you have the giver, the manager, and the receiver. And here's how that relationship flows in practice. It's a pretty straightforward three-step process. First, the settlor puts assets into the trust. This could be anything, really: cash, stocks, real estate. Step 2, the trustee takes control and manages those assets according to a very specific rule book called the trust document. And finally, Step 3, the beneficiaries get to enjoy the rewards, whether that's income from the assets or the assets themselves. It's a really clear chain of responsibility and benefit. All right, now that we've got the basic structure down, let's get to the big question. Why? Why do so many people go through the trouble of setting up a trust? Well, it usually boils down to one massive advantage: the unique way trusts are treated for tax purposes. And here it is. This is the single most important principle you need to remember. Income that a trust earns is only taxed one time. Now, that might sound almost too simple, but as we're about to see, this simple rule helps you avoid a major financial trap that exists in other business structures. This slide really lays it all out. Look at the right side, the corporation. When a company makes a profit, it pays corporate income tax. Then, when it pays out what's left to its shareholders as dividends, those shareholders get taxed on that income again on their personal returns. That's double taxation. But look at the trust. It completely avoids that second layer of tax. The income is only taxed once. That's it. And this is where the real genius of the structure comes in. It's all about flexibility. The trustee gets to choose. Does the trust pay the tax on its income, or do we flow that income through to a beneficiary and let them pay the tax? This lets them make a strategic decision each year to give the income to whoever is in the lower tax bracket, which can lead to some really significant tax savings. Okay, so we've established that trusts have this huge tax advantage. But, not all trusts are created equal. Let's break down the two main categories you're going to encounter, and they're distinguished by when they come into existence. The first kind is called an inter vivos trust. It's Latin, and it literally means between the living. So a simple way to think of it is as a living trust. It's created by the settlor, and it becomes active and starts operating while the settlor is still alive. So a really classic example of this is a parent who puts, say, a portfolio of rental properties into a trust for their kids. This allows that parent, who might be the trustee at first, to professionally manage that property and the income it generates for their children's benefit right now, not just as some far-off inheritance. Maybe that money is used to pay for university or for a down payment on a first home. Now, the second major type is a testamentary trust. So if an inter vivos trust is a living trust, you can think of this one as a trust created through a will. It actually doesn't spring into existence until after the settlor has passed away. This is an incredibly common tool in estate planning. It's a way for a parent to essentially say, I want my children to inherit my assets, but I don't want them to get it all in a lump sum the moment they turn 18. The trust serves to protect and invest the inheritance, and the trustee can be given instructions to pay it out in stages. Maybe a third at age 25, a third at 30, and the final portion at 35, once they've had a chance to mature financially. Okay, let's switch gears and get into some of the technical details. We're going to walk through some of the specific tax rules that you absolutely have to understand if you're dealing with trusts. Now, I know there's a lot of detail on this slide, but let's just focus on the big picture here.
First, for tax purposes, a trust is treated as its own person, a separate taxpayer. Second, and this is important, when income is passed to beneficiaries, it keeps its original identity. Dividends stay dividends, capital gains stay capital gains. And third, and this is a huge one, there are some very strict rules about how assets are valued over time. In fact, that last point is so critical that we need to look at it more closely.
Of all the rules we just saw, there is one in particular that often catches people completely off guard. It has massive implications for long-term planning, and it's something every trustee and beneficiary has to be aware of. It's known as the 21-year deemed disposition rule. You see, the government isn't going to let assets grow inside a trust, tax-deferred, forever. So the law says that every 21 years, the trust has to pretend that it sold all of its assets for whatever they're worth on that day. Now, even though it's a pretend sale, it triggers a very, very real tax bill on all the capital gains that have built up over the last 21 years, and that can be a massive financial event if you haven't planned for it. But as with most tax laws, there are some important exceptions to the general rules. For instance, a brand new testamentary trust can actually get access to lower, graduated tax rates for its first 3 years of existence. But probably the biggest exception applies to spousal trusts, which can be exempt from some of the toughest rules, including that 21-year deemed disposition clock. So with all these rules and types in mind, where do we actually see trusts being used in the real world? Well, they generally fall into two broad camps: personal trusts and commercial trusts. This table breaks down the difference really nicely. On one side, you have personal trusts. These are all about estate planning and are typically set up as a kind of structured gift, like the family examples we've been using. On the other side, you have commercial trusts, which are basically investment products that you buy into, like a mutual fund or a real estate investment trust, which you might know as a REIT. And this really brings us to our final and perhaps most critical takeaway from all of this. This is not just academic theory. The legal structure you choose for your business, for your investments, for your family assets, it will have a direct and significant impact on your financial outcome. As this quote makes clear, your choice of structure, whether you go with a trust, a corporation, or something else, is going to fundamentally change your cash flows, your tax bill, and at the end of the day, your ultimate return on investment. Getting this decision right from the beginning is absolutely fundamental to sound financial planning. So I'll leave you with this final thought to consider. Imagine you are advising a family business that's just starting out. Based on everything we've covered today, how would that choice, a trust versus a corporation, fundamentally change their financial reality, not just for next year, but for the next 20, 30, even 50 years? The answer to that question really gets to the heart of why understanding these structures is so powerful.